On February 20, 2025, the cryptocurrency landscape experienced a seismic shift as reports emerged detailing the withdrawal of approximately $99 million worth of assets from the Milei-backed Libra token. This incident has raised eyebrows in a market already grappling with its share of controversies and challenges. Experts are now closely scrutinizing the implications of this significant withdrawal not just for the Libra token itself but for the broader cryptocurrency ecosystem. In a statement to Reuters, researchers underscored the magnitude of this withdrawal, which marks a critical moment for the Milei-backed initiative. The Libra token, conceived as a digital currency aimed at improving financial access, now faces questions regarding its stability and the trust of its investors. This withdrawal could signal deeper issues within the project, potentially affecting its credibility and future viability, warned one researcher, emphasizing the need for transparency in the project's operations. Simultaneously, the cryptocurrency sector is also grappling with the growing prevalence of scams, particularly those centered around crypto ATMs. Local news outlets reported an alarming rise in fraudulent activities associated with these machines, highlighting how scammers exploit the relatively unregulated nature of cryptocurrency transactions. The lack of robust consumer protections has left many individuals vulnerable to financial losses, raising urgent calls for comprehensive regulations to safeguard investors. Adding to the regulatory discourse, recent developments from the U.S. government indicate a potential pivot in the approach to cryptocurrency oversight. President Trump's executive order on digital financial technology marks a significant departure from the previous administration's policies aiming to foster innovation while ensuring consumer protection. The establishment of the President's Working Group on Digital Asset Markets signals a commitment to create a clearer regulatory framework for cryptocurrencies, which many in the industry view as a crucial step toward greater legitimacy. Acting SEC Chairman Mark Uyeta's decision to reboot the Crypto Task Force, appointing Commissioner Hester Peirce to lead its efforts, further underscores this shift. The task force's objectives include clarifying the status of various crypto assets under securities laws and developing a more consistent enforcement strategy, a move welcomed by industry stakeholders who have long criticized the SEC for its punitive approach. "We are working hard to provide a clearer path for innovation within the regulatory space," Peirce stated, indicating a willingness to engage with the crypto community to shape a more cohesive regulatory framework. The implications of these regulatory changes could be far-reaching. As the crypto landscape evolves, there is potential for increased investment and new entrants into the market, particularly as the SEC signals a more collaborative approach. This could lead to innovations that not only enhance existing technologies but also pave the way for new financial instruments and services. However, the challenges remain daunting. The cryptocurrency market is notoriously volatile, and incidents like the massive withdrawal from the Libra token only serve to heighten skepticism among investors. As the industry strives for legitimacy, the need for comprehensive regulations that protect consumers while promoting innovation has never been more critical. Looking ahead, the intersection of cryptocurrency and technology continues to evolve. With ongoing discussions about the impact of AI on the crypto landscape and the emergence of new business models, stakeholders must remain vigilant. The future of cryptocurrency will likely hinge not only on regulatory clarity but also on the community's ability to navigate the complexities of an ever-changing technological environment. In conclusion, as the dust settles on the recent events surrounding the Milei-backed Libra token and the broader regulatory landscape, the cryptocurrency industry stands at a crossroads. With potential regulatory reforms on the horizon and an urgent need for enhanced consumer protections, the coming months will be pivotal in shaping the future trajectory of digital assets. Investors, innovators, and regulators alike must work collaboratively to build a sustainable and trustworthy ecosystem that can withstand the challenges ahead. The cryptocurrency market is currently experiencing heightened tension as major financial institutions such as JPMorgan issue stark warnings regarding Bitcoin's future price trajectory. As Bitcoin struggles to maintain momentum below the $100,000 mark, analysts are sounding alarms over what they perceive as weakening institutional demand and potential price suppression. In the wake of Donald Trump's election victory, Bitcoin initially surged past the $100,000 threshold. But that momentum has since stalled. The price has remained stagnant over the past week, leading to speculation among traders and analysts alike. Samson Moe, a prominent figure in the Bitcoin community and CEO of January 3rd, expressed concerns at a recent crypto conference, likening the current price behavior to a manufactured situation. Moe cautioned that the market may be facing a death cross, a technical analysis pattern that occurs when a short-term moving average crosses below a long-term moving average, often signaling potential price declines. In a recent note, JPMorgan's analysts highlighted the troubling trend in institutional demand for Bitcoin and Ethereum futures, describing it as a bearish indicator for the crypto market in the near term. They noted that the weakening demand is particularly concerning for institutional investors utilizing regulated futures contracts through the Chicago Mercantile Exchange (CME). This is a negative development and indicative of demand weakness, the analysts stated, further warning that futures prices could fall below spot prices, a situation not witnessed since mid-2024. Further compounding the bearish sentiment, other analysts have projected that Bitcoin could plummet to approximately $70,000 if key support levels are breached. Tyler Ritchie, co-editor at Sevens Report Research, indicated that the current sideways price action coupled with diminishing momentum signals suggests the possibility of a significant decline. The benchmark support level for Bitcoin has been identified at $91,500. Should this level falter, the market could face a rapid descent to the $73,400 range, reminiscent of its performance in early 2024. Despite the current market struggles, there are signs of institutional interest. Notably, Abu Dhabi's $1 trillion sovereign wealth fund recently made headlines by investing $436 million in BlackRock's spot Bitcoin exchange-traded fund ETF. This move signifies a broader trend of institutional adoption, with BlackRock leading efforts to secure ETF approvals in the U.S. in 2023. The launch of several Bitcoin funds in January 2024 marked a pivotal moment for the industry as U.S. spot Bitcoin ETFs collectively surpassed $100 billion in net assets for the first time. However, the recent trend of net outflows from U.S. Bitcoin ETFs, coupled with a shift in market sentiment, now categorized as fear according to the Crypto Fear and Greed Index, has raised concerns. Market analysts have noted that such sentiment shifts typically indicate a lack of confidence among investors, which could deter potential buyers and exacerbate the downward pressure on prices. As the cryptocurrency landscape continues to evolve, the interplay between institutional demand, regulatory developments, and market sentiment will be critical in determining Bitcoin's future. With analysts divided on the outlook, the coming weeks will prove crucial in assessing whether the current bearish signals will materialize into a more substantial downturn or if Bitcoin can regain its footing and rally toward new heights. The market remains watchful as it navigates these turbulent waters, with investors eagerly awaiting clearer signals in the ever-fluctuating world of cryptocurrencies. In the rapidly evolving landscape of cryptocurrency, few developments have generated as much buzz as the emergence of the Trump token. Launched just days before the anticipated return of Donald Trump to the Oval Office, this meme coin has quickly ascended to prominence, raising questions about its viability as an investment and the implications for the broader crypto market. The Trump token, which has garnered attention for its association with the former president, has achieved a remarkable feat. Within just 2 days of its release, it reached a fully diluted valuation of approximately $70 billion, positioning it as the 15th largest cryptocurrency globally. This meteoric rise has sparked a mix of enthusiasm and skepticism within the crypto community. As Eric Demuth, CEO of Bitpanda, noted, the current market dynamics are shifting from speculative trends to more stable long-term investments, particularly influenced by the Trump administration's favorable stance toward digital assets. While the allure of the Trump token is undeniable, it is essential to approach this investment with caution. Like other meme coins, its value is largely driven by social media hype, community sentiment, and celebrity endorsements, rather than any intrinsic utility. This volatility poses risks particularly for novice investors drawn in by the prospect of quick gains. As seen with past meme coins, the potential for sharp price corrections looms large, especially as the initial excitement fades. Amid the frenzy surrounding Trump, other entities are capitalizing on the crypto momentum. Old Glory Bank, a pro-America financial institution, has expanded its payment options to include the Trump token alongside established cryptocurrencies like Bitcoin and Ethereum. This initiative, facilitated through a partnership with Alt 5 Sigma Corporation, reflects a growing trend of integrating digital assets into traditional financial frameworks. According to Mike Ring, CEO of Old Glory Bank, accepting cryptocurrency for their Regulation A+ offering underscores the increasing significance of digital assets in financial transactions. As the Trump token continues to capture the public's imagination, it also raises broader questions about the future of meme coins and their role in the cryptocurrency ecosystem. Whether this token can maintain its momentum or will succumb to the typical pitfalls associated with speculative assets remains to be seen. Analysts caution that while short-term trading opportunities abound, investors should be wary of the long-term sustainability of such assets, particularly given their lack of foundational utility. In addition to the Trump token, the overall cryptocurrency market is witnessing a shift, with institutional investors showing increasing interest. As Demuth pointed out, this influx of sticky money indicates a maturation of the market wherein major players are committing capital for the long haul rather than chasing fleeting profits. The growing interest in Bitcoin exchange-traded funds ETFs also signals a shift towards more regulated and stable investment vehicles. As we look ahead, the trajectory of the Trump token and the broader meme coin phenomenon will undoubtedly shape the future of cryptocurrency. While the excitement surrounding this new asset class is palpable, it is crucial for investors to remain grounded, conduct thorough research, and consider the potential risks involved. In this evolving landscape, staying informed will be key to navigating the opportunities and challenges that lie ahead in the world of digital assets. In the ever-evolving landscape of cryptocurrency, Ethereum ETH has recently shown signs of potential recovery, with analysts pointing to a significant decline in transaction fees as a bullish indicator for the asset's mid to long-term price outlook. According to crypto analytics firm Sentiment, the average fee for transferring Ethereum has plummeted to just 41 cents. A stark contrast to the peak of $15.21 seen in the past 2 years. This decrease in transaction costs is indicative of a less congested network, which Sentiment suggests is a positive signal for ETH's future. When users are not paying high prices to move their ETH or tokens, it is typically a good sign for mid-term and long-term price outlooks, Sentiment noted in a recent post on the social media platform X. The firm further explained that low transaction fees often occur when market prices are perceived as low or bearish. Such affordability can entice new investors to enter the Ethereum market, fostering broader participation in the ecosystem. Conversely, high fees are often a result of increased network activity, usually triggered by rising ETH prices as traders rush to capitalize on upward momentum. At the time of writing, Ethereum is trading at approximately $2,712, having seen a nearly 3% increase over the past 24 hours. This uptick is part of a broader narrative that suggests the cryptocurrency market may be on the brink of a resurgence, particularly for Ethereum, which ranks as the second largest cryptocurrency by market capitalization. However, while the drop in transaction fees is encouraging, it comes amid a backdrop of mixed sentiment regarding Ethereum's long-term prospects. Recent reports have indicated that Ethereum's performance has lagged behind that of Bitcoin over the past 6 months, with ETH appreciating by only 7% compared to Bitcoin's remarkable 67% gain during the same period. This underperformance has prompted the Ethereum Foundation to implement leadership changes aimed at revitalizing the project and addressing ongoing challenges, particularly regarding high gas fees and transaction speeds. The proposed shakeup within the Ethereum Foundation aims to infuse technical expertise into its senior ranks, which is crucial for steering the development of Ethereum's blockchain technology. Such advancements are particularly pertinent as the demand for decentralized applications, especially those leveraging artificial intelligence, continues to grow. Additionally, fostering better communication and collaboration within the Ethereum community has become a priority, especially in light of recent internal dissent. Despite these positive developments, critics point to Ethereum's persistent challenges with gas fees and transaction speeds, which remain significantly higher than those found on competing platforms like Solana. While Solana has garnered attention for its rapid transaction times and low costs, Ethereum's ongoing issues could hinder its ability to attract new users, particularly those drawn to the burgeoning meme coin market that has found a more hospitable environment on Solana. As the cryptocurrency landscape continues to shift, investors are left weighing their options. Ethereum's current leadership changes may eventually lead to improved performance in the market, but for the time being, analysts suggest that Solana may be better positioned to capture growth in the sector. With Ethereum's future still uncertain, potential investors are advised to remain vigilant and consider the broader market trends before making investment decisions. In conclusion, as Ethereum navigates a pivotal moment marked by both challenges and opportunities, the coming months will be critical in determining whether the recent drop in transaction fees will translate into a sustained recovery for the asset. The upcoming changes within the Ethereum Foundation, along with the competitive landscape posed by platforms like Solana, will undoubtedly shape the future of Ethereum and its role in the broader cryptocurrency market. Investors will be closely watching for signs of progress as Ethereum seeks to reclaim its stature in the rapidly evolving digital economy. In the rapidly evolving landscape of cryptocurrency, a fierce rivalry is brewing between Solana and Ethereum, two leading platforms that have captured the attention of investors and developers alike. As Solana's growth trajectory continues to outpace Ethereum's, a debate is intensifying on which of these blockchain behemoths represents the better investment opportunity. In a remarkable demonstration of market enthusiasm, Solana has surged an astonishing 1872% over the past 2 years, leaving Ethereum's 124% growth in the dust. This meteoric rise has led analysts to reconsider the competitive dynamics within the decentralized finance DeFi space, where Ethereum has long held the crown. As of February 2025, Solana's market cap stands at $104 billion. While Ethereum, despite its earlier dominance, is currently valued at approximately $325 billion. The reasons behind Solana's remarkable performance are multifaceted. Much of its early growth can be attributed to a rebound following the collapse of FTX in late 2022, which initially tarnished its reputation due to its ties with the exchange's founder Sam Bankman-Fried. This sharp decline left Solana's value vulnerable, but it also provided an opportunity for recovery as investors began to recognize its potential. As Kathy Wood of ARK Invest pointed out in November 2023, Solana's technical capabilities, including faster transaction speeds and lower costs, position it as a superior Layer 1 blockchain compared to Ethereum. This shift in perception is reflected in Solana's increasing dominance across several key metrics. Recent reports indicate that Solana has surpassed Ethereum in daily active users, transaction counts, and developer adoption. Notably, the introduction of platforms like Pump.Fun, a meme coin launchpad, has further solidified Solana's position in the competitive landscape, attracting a wave of new users eager to engage with the burgeoning meme coin culture. However, the recent market dynamics reveal a more complex picture. While Ethereum has experienced a resurgence, hitting a 12-day high of $2,849.50, Solana has faced challenges, including a significant $772 million decline in liquidity. The meme coin frenzy, which has fueled much of Solana's growth, also faced scrutiny, with high-profile rug pulls leading to concerns about the sustainability of this segment. As experts note, the impact of such controversies could diminish the momentum Solana has built. Despite these challenges, Ethereum's recent developments, including an increase in institutional adoption of its ETFs, suggest that it remains a formidable player. Data reveals that institutional ownership of Ethereum ETFs has surged from 4.8% to 14.5% in the last quarter, highlighting growing confidence in its long-term viability. Meanwhile, Bitcoin is also entering the fray with new Layer 2 solutions aimed at capturing DeFi liquidity, potentially reshaping the competitive landscape further. As the market continues to evolve, key figures in the Ethereum community, including co-founder Vitalik Buterin, an advocate for a measured growth strategy that emphasizes technical improvements. This contrasts sharply with the more speculative elements driving Solana's current popularity, particularly in the meme coin arena. In conclusion, the rivalry between Solana and Ethereum exemplifies the broader narrative of innovation versus tradition in the cryptocurrency space. While Solana's rapid ascent showcases the potential rewards of embracing new trends and technologies, Ethereum's foundational strength and growing institutional interest indicate that it is far from being out of the race. As investors weigh their options, the future of these two platforms will likely be shaped by their ability to adapt to a quickly changing environment, one that is defined by both technological advancements and shifting investor sentiment.